Good morning, everybody, and welcome to today's session, our first edition of HUBsights. My name is Andrew Fraser. I'm the State Manager for HUB24 here in New South Wales. This is our first edition of HUBsights, which is a monthly webinar series that we'll be running to showcase some of our key fund partners. If you're looking for the invitation and RSVP, you'll find that on a monthly basis in your regular @Hub email, and we encourage you to look at that and to, of course, dial in. As a little bit of a side and a plug, HUB24 has recently been independently rated by Investment Trends as best in market for our SMA managed portfolio capability. It's something that we're certainly very pleased about and hang our hat on. And to that end, today we're showcasing two of our key SMA partners in Arnhem and Nikko. From Arnhem, we've got Gino Rossi, who's going to be talking to you about global healthcare in a post-Trump era. And from Nikko, we have Tim Johnston, who's going to be talking about their concentrated equity strategy. We look forward to your engagement and your questions throughout this process. At the end, we're going to be opening up for question time. Each manager will speak for about 15 minutes, and then we'll open up to questions. We're going to open up the lines for both verbal questions, or you can lodge questions through the GoToMeeting interface. On the right-hand side in your drop-down menu, you'll see an item labelled questions. Please feel free to submit those questions during the webinar. If you could just make a point of who you're directing the question to, be it Nikko or Arnhem, and we'll make sure they're picked up at the end of the session. Thanks again for dialing in. I'm going to pass over now to Gino from Arnhem to kick things off. Thanks, Gino.
Thank you. Thanks for joining. So today I just want to talk about, intro Arnhem briefly. I'm going to talk about non-communicable diseases and then go into a bit more detail about cardiovascular, cancer and diabetes. I'm going to talk about Trump, so what we're thinking there, and then some of the opportunities on our radar in healthcare. So in terms of Arnhem, we think we have a unique product. We construct global equity portfolios for Australian investors. What I mean by that is that what we find is most investors domestically own a lot of banks and a lot of resources. When they, or if they go and invest internationally, they tend to fund it from cash, which means an additional 30% in banks and resources. And the problem here is that banks globally are highly correlated. Interest rates are linked, Basel regulation is around the world, and resources likewise. They're all following the same commodity prices, so highly correlated. So we think adding to that exposure doesn't make a lot of sense, particularly if you can get same exposure domestically and getting the franking credit. So we screen industries for how much they overlap with domestic exposure. So we don't own REITs, we don't own banks, we don't own resources. We do own a lot of tech and healthcare, which you simply can't get domestically and has high growth. So that's how we construct specifically for Australian investors. Now, today I want to talk about healthcare and I want to talk about non-communicable diseases. So these are diseases which are not transmitted, so you can't catch cardiovascular disease, you can't catch diabetes. You may also know them as chronic conditions. Typically, chronic conditions are quite severe and long-lasting, and the World Health Organization estimates that 68% of all deaths are from these non-communicable diseases. So in Australia, 45,000 people die annually from cardiovascular disease, similar number of deaths from cancer. And if you're a male, by the time you're 85, you have a 1 in 2 chance of being diagnosed with cancer, 1 in 3 if you're a female. That's Australia, where we have a great healthcare system. In China, you're twice as likely to die from a chronic condition, and in India, it's nearly 3 times as likely. So these are huge problems, and I'll talk about some of the ways we invest in these diseases. So firstly, cardiovascular. In cardio, the most common problem is coronary artery disease. So about a third of heart-related hospital admissions are to do with coronary artery disease, which is a build-up of plaque in your coronary arteries. If you have that problem, you may need a stent, which is that top right product. But there's a lot of things that can go wrong with your heart, and I warn you not to Google heart disease because it's very scary. You may have an arrhythmia, where your heartbeat is irregular. You'll need a pacemaker, which is top left.
You may have a structural heart defect, which is the bottom right. You may have a hole that needs plugging up. And then the bottom left there is a left ventricular assist device. That's very serious. That's if your left ventricle can't pump the blood around the body and you need a pump to do it for you. A lot of innovation in this space, however, and one example I'll give is a T-bar. So in the past, if you had a thing called aortic stenosis, where your aortic valve was not opening fully enough, you needed open heart surgery. So that would involve the surgeon cutting through your sternum, prying open your chest. They'd have to stop your heart and hook you up to a lung and oxygen, lung and pump machine to do the heart's job for you. So imagine yourself sitting on the operating table, chest open, heart stopped. Not very pretty. Now with TAVR, which stands for transcatheter aortic valve replacement, the surgeon can go in through your transfemoral artery, which is near your groin. They'll guide a catheter all the way to your heart. They will then dilate a balloon, which will push open the old valve and put a new valve in its place. Take the catheter out, that's a 2 to 3 day recovery. So you can see the difference there. Likewise, in pacemakers now, they can deliver that with a catheter. In the past, you needed a pocket near your collar, quite awful infection, shoulder problems. Now, again, minimally invasive, quick turnaround. You can see the trend in cardio and the innovation in cardio. For us, we own Abbott. So Abbott was the 4th largest cardiac device manufacturer. They bought St Jude, which was the 2nd largest. And I think that's a great acquisition on a number of fronts. Firstly, $500 million of synergy. And when I analyse that, I look at how that compares to other mergers and what the margins that implies are. I'm very confident they can get that number. The other thing is huge complementarity between the businesses. So that bottom right chart, I know it's a bit small, but you can see where Abbott was strong, St Jude less so, and vice versa. So bringing them together was very complementary. Now there's 1 and 2 in most categories in cardiac. And thirdly, St Jude were in a bit of a lull. Particularly their pacemakers were not MRI safe, and that was costing them quite a lot of share. So Abbott were able to pounce at an opportune time. So I'm confident that in cardio, Abbott and St Jude together will outstrip the market's growth. So I'm pretty confident in that investment. Cancer, here we own Roche. I want to talk about lung cancer, less of a problem in Australia because of our anti-smoking campaign, but globally 1.6 million people die of lung cancer every year. Big problem, massive market, and really why lung cancer is particularly interesting is because it's a real battleground for immuno-oncology. So you might have heard of immuno-oncology. This is the principle that says, well, your best defense against tumours is the body's immune system, but tumours are very good at evading it, so let's work out some of the techniques by which they do this and develop drugs to disable it. You might have seen on the 6 o'clock news, Merck's Keytruda was heralded as a breakthrough treatment in lung cancer. It is a very good treatment. 45% of cancers or tumours shrunk compared to chemo, which was 28% shrinkage. But what the news didn't tell you is that only 25% of patients will benefit from this in first-line treatment. Because what happens is the physician will take a biopsy of the tumour from your lung. They will then test it for this PD-L1 protein, which you can see up the top right, which stands for programmed death ligand. That's something in the cells. And if you don't have enough of those PD-L1s being expressed on the surface of your tumour, you're not going to get prescribed Keytruda as a first-line treatment. So there's 75% of patients which are still going to be given chemo as a first-line treatment. So the race is still on here. In the mix, you've got Roche, you've got Merck, you've got AstraZeneca, and you've got Bristol Myers Squibb. Thing to keep an ear out for is AstraZeneca's MYSTIC trial, which will come out around the middle of the year. That'll be very key to lung cancer, so keep your ear out for that. In terms of Roche, historically they've been very strong in breast and blood cancers. They are doing well in lung cancer. They're approved for second-line treatment and they are taking share. But for us, really, it's more good than that. They're strong across the board, they're strong colorectal as well. And what we like about Roche is that 60% of the revenue, $50 billion of annual revenue, comes from oncology or cancer. So of the major pharma companies, they are the most focused on cancer. 10 billion of annual R&D, most of that going into cancer. So you can see when Roche rock up to the roulette wheel, they can place many, many bets, whereas other companies are having to really take a pick and follow one or two leads. So I think that's a big advantage for Roche. Secondly, they're the world's biggest diagnostics equipment manufacturer. So if you go and get a blood test, chances are that'll be done on a Roche machine. And as with Merck's Keytruda, most drugs now are being approved with an associated test. So the doctor will test you for your suitability to a drug. So having that testing and that drug development under the same roof is a big advantage for Roche. Diabetes. In diabetes, we own Novo Nordisk. And the story is pretty simple in diabetes. You've got 110 million people in China with diabetes, and only 23% are being treated currently. 60% of the diabetes market is in the US, and yet the US only has 10% of the world's population of diabetics. So this is very much an emerging market story. The other thing with Novo Nordisk is they are dominant in a class of drugs called GLP-1, that stands for glucagon-like peptides. So this drug basically makes you feel full, slows the release of food from your stomach. It controls the amount of glucose your liver produces, stimulates insulin by the pancreas. It reduces your risk of stroke by 39%, reduces your risk of heart attack by 26%. So it's no surprise this class of drugs is growing at 20% per annum, and Novo at 58% market share. And Novo should get approval for their latest and greatest drug, which means that market share will go even higher from here. So for us, Novo is very strong in insulin. They're dominant in GLP-1, big emerging market story. We're quite confident in that stock. Trump. Are we worried? Yes, we are. Very worried about Trump. But I think it's important to put in a historical context. So historically, the healthcare sector has traded at a 15% premium to the index, like PE premium. Why? I think that's justifiable. I know aging demographic gets thrown around a lot, but when you look at the numbers, it's pretty staggering. Person over 65 is going to be admitted to hospital 4 times as much, 3.5 times the pathology test. Now, recently spoke to the largest insurer in the US called United, and they reminded me person over 65 has 5 times the number of prescriptions. So if you run the population data through on those metrics, you're getting at least, at a minimum, an extra couple % of growth just from aging. That's before innovation, that's before increased utilisation. Healthcare is growing very strongly. Now, 15% premium historically, currently healthcare is at a 10% discount to the index. I would have to go back to 1993 when Bill and Hillary Clinton were proposing universal health coverage, a lot of government oversight, quite negative for the private sector. I'd have to go back then to last buy the healthcare sector at such a discount to the index. So yes, there are risks, but you know our fund has only 20% turnover, so implicitly a 5-year investment horizon. We think you should look through this short-term risk, and you know we can pick up Roche on 16 times PE. We can pick up Novo on 16 times, Abbott 18 times, and as Tim will cover off later, good luck buying anything in Australia under 20 times. So, you know, we think there's great opportunities and a lot is reflected in the price. Also goes to the stocks we're targeting. So we're targeting innovators. So we look at Roche and Abbott, a lot of new products coming through. It's these new products where the healthcare payers will go, okay, well, you're saving lives or you're saving hospital costs, we'll pay you for that. If you've got a stale portfolio of old drugs, prices are going to go down. We've got enablers. So CVS has Cerner is the world's largest healthcare IT company, and how better to save costs in healthcare than through IT? Price leaders, Novo Nordisk, they've already operate in a very hostile pricing environment, and management strategy is now akin to that. They're in tune with the fact they have to go for volume, they have to be aggressive on price. They're already there. They're price leaders. And then the final class of stock we like to invest in is non-government or diversifiers. Here we own VCA, which is America's largest chain of vet hospitals. And again, there, you don't have that same pricing pressure, fragmented customer base. So dental, animal are quite attractive from that point of view. Mars have come along and paid 30% more for VCA, so we're looking for a stock to replace that one. And just finally, some of the opportunities we still see out there in healthcare. Firstly, Intuitive. So Intuitive makes surgical robots. So you can see the picture there. The surgeon sits at a terminal and controls, I guess, these minimally invasive surgery instruments to perform surgery. So in Australia, if you've had a prostatectomy, it's probably a 95% chance you've had it done with a Da Vinci robot. Hysterectomy is also very common. But the story here is really that currently it's mainly prostatectomies, hysterectomies, but it's being used increasingly in hernias, colorectal surgery, and it's just going more into general surgery. The other nice thing about this business is that it's 70% recurring revenue. So it's a nice annuity stream business. We think we'll get an opportunity to buy them a little bit cheaper with some uncertainty around Trump. Illumina, they are 80% of the genetic sequencing market. I'd be very surprised if any listener has had their gene sequenced. I certainly have not. So this is an area which is still a domain of research and government, but it will come to the clinic. So again, in cancer, they'll take a biopsy of the tumour and they'll just sequence the whole thing. That'll then dictate what drug you get. So it is a very high growth industry. Illumina is currently very dominant in it. And then Align Technology, you might have seen the Invisalign sign around. So about 50% of people don't need wire braces. They can use these clear aligners. And here this stock's growing at 20%. Geographic expansion and also new products to handle more complex orthodontics. And also making it available to general dentists as well. So a nice growth business, that one. Thank you.
Terrific. Thanks very much, Gino. Guys, as mentioned, just to reiterate, keep the questions coming through. So use the online interface or save them up for a question at the end. That's fine. I'll now hand over to Tim Johnston from Nikko. Thanks, Tim.
Thanks, Andrew. Good morning, all, and thanks for your interest. I thought I'd just start the presentation with a quick overview of Nikko AM Australia and our investment process, followed by a review of the characteristics of the Nikko Australian share concentrator strategy. After that, I'll briefly run through our portfolio positioning and then give a rundown on two of our current stock holdings. So our process at Nikko, well, just a bit of background on the business. I'm sure you're all aware that Nikko AM in Australia is the former Tyndall Australian Equities business. So we were acquired by Nikko in 2011. But other than the change in name and the access to the broader Nikko teams globally, our business is largely unchanged. And our investment process, which has served us well for over 25 years, is entirely unchanged. That is a process designed to identify stocks trading at a discount to their intrinsic value or fundamental value. We have a team of 11 with an average of 16 years of experience in investment markets. So it's a very experienced and well-resourced team, solely focused on identifying mispriced stocks. We are bottom-up investors with a value philosophy, and we determine intrinsic value based on the economic fundamentals of each company. So we have a particular focus on sustainable earnings and cash flow generation of each company, and we also consider the riskiness of the business franchise. So we believe this forward-looking intrinsic value approach results in superior outcomes than a more academic approach to value investing, and that's largely through the avoidance of value traps. And using our framework, we can readily compare all stocks in the market on a consistent and objective basis to identify the mispriced opportunities. So the concentrated strategy is a unique offering in the Australian marketplace by virtue of its key characteristics. Before I go into those intricacies of the strategy, I think it's worth noting that the strategy has actually been around for 18 years in the institutional space. On the back of strong long-term performance, the strategy was made available to retail investors in 2010 and it's been available on HUB24 since September 2015. So what are the characteristics that has been appealing to investors for those 18 years? Well, in summary, this is a strategy that provides investors with a bottom-up, high conviction and high yielding portfolio. The portfolio is total return focused, but it has a yield overlay. You should consider the yield overlay in two ways. Firstly, it acts as a quality filter. we aren't looking for the highest yielding stocks in the market, but rather companies with strong and sustainable cash generation and a history of rewarding shareholders with dividends. The second way to think about the yield is that for a majority of the market cycle, the yield bias in the portfolio leads us towards more defensive sectors of the market. So typically businesses in more mature and stable industries have lower reinvestment requirements and therefore a capacity to return a higher proportion of earnings to investors. So the result of our approach is a portfolio that provides investors with a higher than average yield, or higher than market yield I should say, a below market beta, so lower risk, and a skew towards lower volatility earning streams. Excuse me. The portfolio is also concentrated in nature. It's only got 15 to 25 stocks, so it does represent our best ideas, and there's no portfolio killers. And then finally, the portfolio is constructed on a benchmark unaware basis, meaning that the size of any holding in the portfolio isn't set with regard to the size of the stock in the benchmark index, but rather it's set with regard to the value on offer and our conviction in the investment thesis. We also consider liquidity because we do want to be nimble to take advantage of opportunities. So you can see that we have a maximum absolute stock weighting of 8%. We'll hold no more than 8% in any one stock. There has been a couple of occasions where that has restricted our ability to have a market position in, say, BHP when it was 15% of the index, or CBA when it was 10% of the index. But we would argue that when stocks are trading at such large proportions of the index is when they're most overvalued. So we don't consider this to be an issue, and in fact, a more pragmatic way to manage risk. In terms of sector exposures, we do want to be diversified, so we do have maximum sector weightings of 20%, with the exception of the financials ex-property trusts, where we have an index plus 10% limit. The reason that we have a larger, or willing to have a larger exposure to that sector is that it is a very big part of the market, but B, it also includes the major banks, which for the majority of the history of this portfolio or the strategy, we have found to be very attractive by virtue of the industry structure, the strong growth and the rationality. In addition to that though, there are other sectors included in there, including the diversified financials, fund managers, insurers and lend-lease. So it's a bit of a mixed bag of stocks, all with unique characteristics and independent drivers. So we are happy to have a much bigger exposure to that sector because of those different characteristics. But the consequence of this, or the outcome of this strategy is a low beta, higher tracking error portfolio, which has delivered substantial alpha over its 18-year history. So if we move on to the next slide, this is a chart showing the history of the portfolio beta. Beta being a measure of market risk, and what you can see is that it is well below 1, and most often in a range of 0.75 to 0.9, meaning that the portfolio on average is defensively positioned. Despite being defensively positioned, it has outperformed the market over the long term. So more recently, you can see towards the right-hand side of the chart, due to low bond yields globally and the pursuit of yield at any price, we saw that the defensive and higher yielding parts of the market had been bid up aggressively and no longer looked value to us. Consequently, we saw much better value in the more cyclical parts of the market, the industrial cyclicals and the financials, and we migrated the portfolio away from the expensive defensives, and as a result, the beta has been close to 1. You can see that that has occurred on previous occasions. Firstly, in 2009, at the depth of the GFC, we saw a very similar thing. The market had run aggressively into defensives, and again, the valuation dispersion has blown out, and cyclicals looked far cheaper, so we aggressively rotated the portfolio there. And then again, you can see in mid-2012 through to early 2013, again, when the QE had started the yield bubble, after a couple of years, again, we saw defensives as being quite extremely valued and rotated the portfolio again towards cyclicals. But over time, as those valuations normalised, we rotated back to where we saw better value in defensives. So just to reiterate, valuation is first and foremost our guiding light. This chart shows the dividend yield of the portfolio by financial year. You can see that the yield bias results in a greater income coming from this portfolio than you get from the market. So the portfolio yield is in blue, market yield is in green. What you will notice is that in recent years, the margin over and above the market yield has narrowed, That's a function of two things. Firstly, the yield compression that we've seen in the market as the expensive defensives have been bid up, reducing their yield. But equally, because we have seen better value in cyclicals, which are generally lower yielding, we have rotated away from those expensive defensives. But what you can see is that historically, the portfolio has delivered anywhere between 100 to 150 basis points of income over and above what you get from the market. And in addition to that, 20 to 40 basis points of franking credits, which obviously is very, very valuable to investors. So just to sum up on the portfolio characteristics, the consequence of this combination of characteristics is we have a value-oriented portfolio with a yield bias leading us towards lower volatility stocks at most points in time. And that really allows us to access a number of anomalies in the market, which are proven to outperform through time and pretty much in all equity markets globally. I'm not going to run through them, but I would encourage anyone interested in learning more about these anomalies to read our research paper, Making the Most of Market Anomalies, which you can find on our website by following the link in the presentation slides. So just shifting to portfolio positioning. Before I delve into the specifics, I should just note that we are bottom-up stock pickers. So each of the stocks included in the portfolio is there because we believe that the market has undervalued them. That is, it's a portfolio of individual opportunities. We aren't selecting companies which are expected to perform under certain thematics or under certain macroeconomic conditions, but rather individual opportunities on companies' individual fundamentals. That said, we are acutely aware of the macro backdrop and the implications that developments in macro conditions can have on valuations, so we do monitor that closely. But if we look at the composition of the ASX 200 split into super sectors, the proportion of the market into the 6 super sectors of defensive industrials, REITs, financials, cyclical industrials, energy and resources, the market composition is shown in light blue, and overlaid with that in dark blue is our portfolio's exposure to those sectors. As you can see, currently we are substantially underweight defensive industrials, substantially underweight REITs, and substantially underweight resources. On the other side of the table, we are modestly overweight financials, substantially overweight cyclical industrials, and overweight energy. Now, I don't intend to go through each of the stock positions that make up those overall positioning, but if we think about the overall positioning being exposed to financials and cyclical industrials, I think it is worth recognising the risk that, or the macro conditions are actually supportive of that positioning. So we are actually seeing valuation signals supportive of those positions, but overlaid with that is a very supportive macro backdrop which should see these sectors outperform. So this chart shows global purchasing manager indices for the key regions around key global regions, and what you can see is that there has been a global upturn, synchronized global upturn starting in mid-2016, and the data just gets stronger and stronger. Obviously don't have time to run through that today, but we are very comfortable with the mix of our stocks given the valuation signals and this overall macroeconomic backdrop. Just quickly on resources, as I said, we're substantially underweight resources. Really that's a function of our concerns around iron ore prices. We cannot understand current pricing of iron ore because it isn't supported by supply-demand fundamentals. This chart shows Chinese port inventories. You can see they're elevated. We know there's a wall of supply coming from Australia and Brazil, and we know that high prices currently have initiated new supply out of India and also an increase in production in China. So just moving on to a couple of the key two positions in the portfolio which might be of interest to you. Firstly, QBE, I'm sure you're all familiar with it, one of the top 20 insurers in the world. This is a stock that we value at around $14. It's currently trading shy of 13. The investment thesis really is around the fact that the market isn't currently paying for the expected 60 to 70% improvement in earnings that we see between FY16 and 19. So this is a company that has had internal issues or internal mismanagement and had cost overruns at the same time as having macro headwinds which have impeded its growth. So if we look at the change in conditions for this company, well, we've had new management come in and strip out cost and also focus on their pricing. So they've been pricing risk poorly for a number of years. That is now changing. We've also had, due to excess global liquidity, additional money flowing into insurance in the pursuit of yield. As interest rates rise and better opportunities for that money become available elsewhere, we think that flow reverses. And then finally, rising interest rates is a positive for QBE because of its asset and liability mismatch. So whilst falling interest rates were a headwind for its earnings and for its capital, rising interest rates will be a positive contributor. So a substantial change in both the company's internal momentum, but also its external environment. And we don't think the market's paying for that. The second stock I thought I'd talk about was Tabcorp. It's a stock we were most recently buying at $4.30. It's now about $4.80. Our standalone valuation is in the order of $4.90, but with a successful Tattersalls acquisition, we see value as sort of $5.30. So a bit of upside remains. Why was the stock cheap? Well, primarily because there's concerns that, or two things, concerns that Tabcorp may have to lift its offer for Tattersalls. We think that's overstated, largely because there is no credible competing bid, and the Tattersalls business standalone is suffering some extremely poor trends. So the board of Tattersalls is supportive of the deal, and there is no better offer currently. The other issue has been that the first half results Tabcorp was relatively weak, but that is largely explainable by the poor weather or wet weather in the first quarter. But every time Tabcorp posts a weak revenue result, the market seems to clutch on the fears that the bookmakers or the UK bookmakers are stealing share. However, the data that the data we have shows that Tabcorp are in fact out-competing a number of those corporate bookmakers. So if you look at fixed odds growth at Tabcorp in 2016, they delivered 28% growth. That compares to the three UK bookmakers, one of whom did 30% off a low base, the other two did 0 and 20%. So Tabcorp is certainly holding its own. And it's also fair to say that the competitive environment has actually, or the competitive intensity has declined in recent years. We have seen yields on fixed odds increasing, suggesting the pricing environment is getting better for these guys. And in addition to that, we do see regulatory change, which will be a major positive for Tabcorp. Basically, South Australian government's looking to implement new taxes, which will level the playing field between Tabcorp and its UK competitors. So it doesn't look extremely cheap on forward PE, but with the cost synergies coming from the Tattersalls acquisition, we can see a company that's going to deliver double-digit earnings growth and a 5% or 5.5% fully franked yield. We think in the defensive space it is quite attractive. So in summary, Australian concentrated strategy provides high conviction and high yielding portfolio. It's outperformed the market for nearly 20 years. For further information, please contact HUB24 or reach out to our sales team. And with that, I'll hand back to Andrew for Q&A.
Thanks very much, Tim. That's fantastic. Well, thanks again also, Gino. There's some great content there, I think, I'm sure, in both of those presentations. And I think looking at, as we went through those, it's fair to say that the Nikko Aussie SMA and the Arnhem Global SMA would likely blend very well together in a portfolio. We will get copies of both of those presentations out to all of you, so you'll have those for reference, and certainly contact points for each of these managers. Might open the floor now to questions, and we'll just check the online questions. Anybody out there want to raise a question for either Tim or Gino? Go ahead. I've got one question here. I'm not sure, there's a bit of background noise there. I think someone might have just unmuted, but if you can hear me, I've got a question that's come through here for Tim at Nikko, just asking if we could get your comments on bank valuations.
Sure. Obviously, quite a bit of noise in the last week or so on the banks around potential regulatory changes. And I guess given the strong run in share prices, a lot of investors are questioning where to for banks. I think there's a couple of things to consider. Firstly, valuations. In our view, the major banks, with the exception of ANZ, look fairly priced relative to the market. In regards to ANZ, it's trading at a discount to the other majors, basically because it's perceived as lower quality. This seems to be purely because of its lower return on equity, which in our view overlooks the fact that the low return on equity is a function of its Asian investments, which the bank is divesting and which will fund ANZ's higher regulatory capital. So while all the major banks need to raise additional equity or additional regulatory capital, ANZ looks best placed to achieve that via the sale of these low-returning Asian investments, and yet the market's overlooking that. I guess more broadly, just thinking about the noise around regulation and capital, well, our valuations have for a number of years allowed for increased regulatory capital. That's been well flagged by the regulator. While there has been some uncertainty over the level that we ultimately sit at, there's no doubt it's going up. So we've been using a 10.5% core equity tier 1 ratio, and that requires the banks to raise anywhere between another 3 and 5 billion each, which the majority of them can do with DRPs over a 2 to 3 year period. Other concerns, I guess, around lending restrictions on investors and interest-only borrowing. You could expect that would slow credit growth, but also I think it's fair to say that the banks are highly rational and they do exert significant pricing power, so they can and will reprice to maintain growth and to maintain their return on equity. So in summary, we think the banks, with the exception of ANZ, are fairly priced. We don't expect significant changes to regulation, and any of the minor tweaks that will occur, we think the banks will recoup with pricing.
Terrific. Thanks very much, Tim. For those of you, perhaps there's a bit of feedback there on the audio a little earlier, so keep, if you've got a question while I wrap up, perhaps just redirect it through the online interface. But in the absence of any other questions, it looks like Tim and Gino nailed all the key points, I think. So inevitably there's going to be some unspoken questions out there in the field, so don't let them go unspoken. Please get in touch, either with myself or your local HUB24 sales contact, or of course directly through to Nikko and Arnhem. We look forward to hopefully having you online again for our future webinars. Don't forget to keep an eye out for your monthly @Hub newsletter, which will keep you posted of those. But in the absence of any other questions, we might wrap things up. Thank you again, everybody, for dialing in.